Hey, how's it going, everyone? My name is Amos, and I want to ask you a question. What makes a stock high quality? In this video, we're going to be going over the criteria list in order to identify a good stock, otherwise known as a dividend compounder with cheese. But before we go anywhere, we should go ahead and define what a dividend compounder is. It's companies that have an investing thesis that writes itself. Companies that are high quality, predictable, and are growing year after year in nearly all regards. And by the way, this is my real voice. This is not AI. And what do I mean about the compounding part? If the company is indeed high quality, then every handful of years, through their stock price growth and dividend payments, my initial investment in them will have compounded. So for instance, if I invested $100 into a stock, eventually with enough time, that would turn into $200 with time in the market in X amount of years. Does that make sense? That's what a dividend compounder is. And don't get me wrong, there's no right or good way to do the stock market. And I know some people get really offended if you question or poke holes into their style of investing, but I am a long-term investor. I don't do swing trades, day trade, or even buy options. I buy and hold a stock for a long time because that's when the compounding magic happens. You need time in the market in order for that stock and the dividends to do the compounding. And as a long-term investor, to me, the company's tangible results, data, numbers, and finances matter because that's how we calculate the intrinsic value, growth potential, and any risks that are associated with a company's stock. I know with speculative day trading, none of that really matters. You only need to look at the stock trading pattern and any hype and catalysts that are in the news. But with that in mind, let's go ahead and look at Intel and Google in this video. By comparing the two with the upcoming metrics, you'll quickly see what it's all about. So there's going to be two categories, the primary and secondary metrics. The two primary metrics that we're going to be considering are the total return and the dividend growth rate. All right, so the first one is the total return. And the timeline that we're going to be comparing the two is going to be January of 2015 all the way to November of 2024. And the reason why we want to consider the total return is because, quite simply, performance matters because that is the variable that does the compounding for the stock price. And we want to do this one first because the total return takes care of all the little details for the most part. Reason being is that if the company takes care of the small stuff, their performance in the stock market tends to be depicted by good gains. Not always, so don't comment exceptions to the rule, but for the most part, this is true. So as you can see on your screen right now, with $10,000 invested into both Google and Intel in January of 2015, this is what would have happened to your money over the span of about 9 years and like 11 months. With Google, that would have transformed into $63,000. With Intel, unfortunately, your money would have shrank to $8,600. And the year-over-year performance, otherwise known as the CAGR, the compound annual growth rate, taking into consideration the dividends reinvested to buy more shares, your money would have grown at a rate of 20% every single year with Google. On the other hand, with Intel, your money would have gone down by negative 1.4% on average. However, that's just what happened on the big picture scale. When we look at the numbers on a year-to-year basis, in their best single year, Google's stock price went up by 65%. And on the other hand, Intel, it went up by 94% in a single trading year. On the other side of the coin, Google went down by negative 39% during their worst year, and for Intel, it went down by negative 51%. So we can tell that Intel is a lot more volatile on both extremes, going up and going down. And for the visual people, let's go ahead and scroll down. The blue line is Google's growth in the stock market for the past 9.5 years, and Intel's, man, your money would have stayed relatively flat up until about, 2020, when your initial $10,000 would have doubled to $20,000. And then since 2020, man, it's just gone downhill. On the other hand, if you look at Google, it's just been growing nonstop, except for the better part of 2022. If you bought into Google in 2022, you are probably a very happy camper right now because that $10,000 went from $33,000 all the way up to $63,800. And for Intel, you probably are not a very happy person right now. Now, the next primary metric we're going to be looking at is the dividend profile and the dividend growth rate. This is also what helps with the compounding. And to a dividend investor, dividends are really important to consider because it shows the company is cash heavy and is able to afford a dividend. And so consequently, without dividends, then it would not be a dividend compounder. And the best part is, while a stock sits in our portfolio, it pays rent to us every 3 months or every month in the form of dividends. Now, Google's current dividend yield is 0.41%, meaning for every share of Google that you own, you get paid 80 cents in dividends every single year. And the payout ratio is 10%, which means the dividend itself is really sustainable, healthy, and there's a lot more room for growth. And on the right side, it says not available for dividend growth. And that's because if we scroll down right here, Google just started paying a dividend for the first time in June of 2024, which means after they pay their next one, that would complete 4 consecutive quarters with dividend payments, which means they would most likely, high probability that they're going to grow that dividend at a double-digit rate. If I was a betting man, I would say probably closer to 10 to 12% for their dividend growth rate, meaning this 80 cents is going to grow by 10 to 12% when they do decide to grow the dividend. And on the other side, let's go ahead and look at Intel's dividend profile. Intel's dividend profile, as you can see right here, it says Intel has recently suspended its dividend payments. So its dividend yield is now 0%. So right off the bat, now we know that Intel is no longer paying a dividend because they are running into operational problems and their future, their forecast is really cloudy and not full of good hopes and dreams. But as we scroll down and look at their dividend history, we can tell for the most part, up until the fiasco with the foundry and everything going downhill, it looks as if they did pay a decent dividend and almost increased it every single year up until about the beginning of 2023, at which point they had to cut this dividend payment from 36 cents every 3 months down to 12 cents every 3 months, and then eventually they just had to get rid of it altogether. So their dividend profile, I would give it an F. This is absolute worst case scenario of a dividend paying company. Moving right along, it's not just those 2 metrics that make up a dividend compounder or a high quality stock. What you see on your screen right now are the other stuff that matter, and we're going to go through each metric one by one. The first one is going to be the cash versus the debt situation. And there's many different ways to evaluate a company's cash health in comparison to their debt. For me, I like to look at the balance sheet. So right now we're looking at Google's balance sheet, and we're going to be looking at the line item net cash to debt. And as we scroll down, here it is right there, the net cash to debt, and it's calculated by taking the cash and cash equivalents on the top line in the assets section and subtracting it with the total debt. So in the case of Google, in the trailing 12 months, this is current right now, they have $63 billion of cash on hand after taking into account their total debt. So I would say this is a very cash heavy company that has a lot more room to deploy their capital how they see fit, to do share buybacks, to increase the dividend, to explore different business segments, to launch different venture projects. The options are limitless when you have $63 billion of cash on hand. And if we scroll up, you could see their total debt picture right there. They have $29 billion of debt. And it sounds ridiculous and it sounds scary until we scroll up and we take a look at how much cash and cash equivalents they have, which is $93 billion. However, I do want to call out, depending on the industry like REITs or utilities, a lot of debt is going to be unavoidable, and that does not mean that the company is bad or is mishandling their finances. But what we want to see in a perfect world for a company that doesn't operate as a REIT or as a utility or some other debt-heavy sector, that they have more cash than debt on hand. Case in point, let's look at Intel. They are a tech company that manufactures semiconductor chips for CPUs, their balance sheet. So right now they have about $24 billion of cash and cash equivalents on hand, which is pretty good. However, once we scroll down and look at their debt situation, let's see if it is still good. Their total debt is $50 billion. So their net cash to debt situation is negative $25 billion. They have a lot more debt than cash on hand. And one thing that I always keep in mind is that a company cannot go bankrupt if they are not drowning in debt. And in the case of Intel, it looks like they are struggling because they're trying to finance and construct and manufacture that foundry that they keep hyping up. And the next secondary metric that we're going to be looking at is their margin. We want to figure out if the company is profitable. And if they are, what is the percentage of profits that they have? And the one that's really important is not necessarily the gross margin, and it's not necessarily the operating margin, but for me, it's the net margin, because the net margin tells you and shows you the amount of profit a company makes from its sales or revenue after taking into account their expenses and operational costs. So in the case of Google, as of right now, their gross margin is about 57%. The operating margin is 30%, and their net margin is 27%. This is beautiful, and that's why a lot of people like to invest into tech companies or big tech, because their net margins tends to be a lot higher than other industries. So a really simple example is if Google generates $100 in sales or in revenue, $27.74 goes into their pocket as profits. Beautiful picture to see. On the other hand, let's go ahead and see what Intel's situation looks like. What you are looking at on your screen right now is Intel's margin situation. I would argue up until about 2022, it was beautiful. Their gross margin was 54% and their net margin was 31%. However, since 2022, look at what happened to their net margin situation. It has just been declining year after year. They showed a little bit of improvement in the beginning of 2024, but since then, it's just been going on a nosedive. And right now, their gross margin is sitting at 34%, and their net profit is negative 29%. Meaning for every $100 that they make, they are profiting $0 from it. Or in other words, if they sell one of their chips for $100, but they spend $120 to make it and to sell it with the overhead costs, then that's also why it results in a negative 29% net margin. So Intel's profitability picture looking terrible and looking pretty atrocious if you were to ask me. Moving right along, the next secondary metric that we're going to be considering is the free cash flow. So if the net margin, what we just looked at right before this, shows us the percentage of profits that they're putting into their pockets, then the free cash flow shows us the actual cash amount that's left over after taking into account funding the operations, overhead costs, and capital expenditures. The free cash flow shows us if a company generates enough liquidity to answer unexpected setbacks or economic downturns, and it shows us that the company is cash heavy. The more cash that a company generates, the less likely they are to take out loans and go into debt to finance their growth, share buybacks, and dividends. So in a perfect world, you want to see the free cash flow situation being stable, and in best case scenario, for it to be increasing and going up as a trend. The first one is going to be Google. So back in 2009, they posted $8.5 billion of free cash flow, and that was right after the Great Recession. And since then, they were pretty stable, which I would argue is a B grade for free cash flow. Then in 2015, it just really started to kick things up, and their free cash flow situation just started to explode. And in 2021, they posted $67 billion of free cash flow. And just this past year, Google posted $69 billion of free cash flow. This is phenomenal. This is beautiful. When I think about Google's free cash flow situation, this gets an A+++++. On the other hand, let's go ahead and look at Intel. Now, what you see on your screen right now is going to be Intel's free cash flow situation. It looks like back in 2009, they posted $6.6 billion of free cash flow. And for the most part, it was stable and it was good. So I would argue up until 2017, their free cash flow situation would get a letter grade of a B from me. To have it stable like this is still a good thing. However, in 2018, their free cash flow started to explode and go up just like Google's did. But this is where Intel's story diverges from Google's, because in 2021, their free cash flow shrunk by over 57% year over year. And since then, their free cash flow situation is just looking really pitiful, scary, and downright dangerous. As of last year, Intel posted negative $14 billion of free cash flow, which tells me that this company is drowning in debt and barely has any cash on hand. So their free cash flow situation, I would give an F as well. And last but not least, another key piece of the puzzle is what separates this company from the competition or potential rivals. The differentiator, aka the competitive advantage that gives them a moat in their industry or sector and protects them from competitors trying to take upon their market share. A competitive advantage is really freaking important because it provides pricing power, unfair profitability, and market share dominance. The last thing you need is a company with no economic moat that is constantly dealing with disruption or industry threats, like when your neighbor yells at you because your dog poops in his yard every single morning. And if that's you, please pick up the poop and throw it away. Please. And whatever competitive advantage that a company has, it usually manifests itself as an economic moat. And just to refresh your memory, an economic moat protects a company from its competition in one way or another. And if you pay attention to your screen right now, there's many different styles and flavors of economic moats. But I'm going to go over the most important ones in my opinion. The first one is going to be the network effect. For example, think about payment processing companies like Visa. The more people that use Visa cards, the more attractive that payment network becomes for merchants and vice versa. To not accept a Visa card is to miss out on potential business from customers. Or when we think about social media, the more people flock to and use YouTube, the more relevant and prevalent it is. If for some strange reason we were all to wake up tomorrow and stop using YouTube and jump over to Vimeo, then I would argue that YouTube does not have that network effect. And the next economic moat is proprietary technology, aka patents, regulatory licenses, intellectual property. And the best example that I can give right now is a company that I'm researching. It's called ASML. They're in the business of semiconductors, and they have this lithography technology that no one else is able to do. And another example is a company that I just recently did an analysis for, and it's Skyworks Solutions and their chips. Another economic moat is the brand loyalty, because if the company is seen as a sex symbol, has a cool factor surrounding it, or what someone is comfortable with, then that's an economic moat. They're gonna buy that product or service because that's the brand that resonates with them. All that to say, we all know someone who refuses to venture out of their comfort zone because they are a ride or die McDonald's quarter pounder kind of guy, a lover of McDonald's. For instance, if they're on a road trip and they're hungry, they'll drive past all the other food options like a Wendy's and a Subway until a McDonald's Golden Arches sign pops up on the highway, and then they pull in and eat at that McDonald's. Another economic moat is high switching costs. This can be expensive in the form of resources, time, or money. So some examples that I can throw out there, think about Cisco and their infrastructure surrounding networks, or even having all of your company data and resources on Google Cloud. Imagine trying to pivot into another cloud provider like Microsoft's. That would be an absolute headache and nightmare. And to round out the discussion surrounding economic moats, we have the efficient scale. Think of this economic moat as the cost advantage that a company has in order to produce goods or services because they have a world-class supply chain, procurement process, or because they're just better than everyone. Some good examples include utility companies that power your electricity or give you water, and transportation companies like Norfolk Southern, Canadian Pacific, and to a lesser extent, Amazon's own delivery services for their e-commerce line of business. So with all that in mind, thinking about economic moats, I would argue Google has a handful of economic moats that it's almost unfair. I say almost because they do in fact have competition that offer a different experience depending on what you're looking for. More specifically, Google has the network effect. Everybody, including your grandma who does not know how to use the internet well, they know exactly what you mean when you say to Google something. Their search engine is the most popular around the world for a good reason because it just works well. And then I would also argue that they have an efficient scale because their apps and platforms are usually best in class and everything is integrated with one another so that if you use YouTube, Gmail, or Google Maps, everything is synced and all of your data and preferences are in one ecosystem of Google. So speaking of which, because of their economic moats, Google has a crap ton of data on people, which allows them to refine their algorithm so that your search experience is catered towards you, even if you're a weirdo that likes to wear socks with sandals. Meaning, if you're a 57-year-old guy who's balding, they're not going to show you ads for Victoria's Secret. Instead, they're going to promote Rogaine in your search feed. And on the topic of economic moats and Intel, I think the only moat they have is being a regional oligopoly, in that Intel operates in the US and is an American business that the government is going to potentially protect. So if there's an issue in the future with China and Taiwan, Intel could be securing manufacturing contracts for chips for all the major players. Although if we're going to be honest with one another, I highly doubt Apple, Google, and Amazon is going to trust Intel over TSM. They're not going to use Intel because Intel has yet to prove itself. And the last thing that Apple wants to do is put a 50-50 quality control chip into their iPhone, because iPhones are known for their quality and craftsmanship. And why did I spend so much time on economic moats, you ask? Well, I think it's because economic moats, that's what separates a high-quality dividend compounder from decent dividend compounders. In my personal opinion, economic moats are what allows the best companies to dominate the stock market. So it's that simple. We covered a lot in this video, and hopefully you learned a thing or two, and you're right. It's a pretty strict checklist. If a company manages to meet all or most of that checklist, then there's a high probability that it's going to be a high-quality dividend compounder with cheese. If a company has a lot of hype, but has terrible finances, then please run away. Run away like Napoleon did back in 1812 when he decided to retreat out of Russia after invading them. Speaking of which, any country that has the courage to invade Russia always falls short because of the winter weather and the land mass. It's not that Russian soldiers are just superior, it's just their geographic location protects them from their enemies. I think in World War II, Hitler also made the same mistake of invading Mother Russia. But hey, you're right, we're getting off topic here. Just please, for the love of sweaty nipples, avoid bad companies, please. If you know that the company has a lot of debt, their free cash flow is declining, and you know they don't have an economic moat, why bother investing into them? Just because their stock price was $100 5 years ago and now it's trading for $10 a share, it does not mean that they're undervalued. Please run away from them. And when in doubt, please ask yourself, would you want to be a business owner of a potential investment that you're eyeballing? Will they be business as usual despite macroeconomic conditions? Running an operation with predictable income? Ask yourself those questions. If there's doubt and uncertainty, maybe go back to the drawing board, because you don't have to purchase that shady and flaky stock. You really don't. You have the ability to move on and pick another company, and that's the beauty of living in a free world. And between you and me, when I ask myself questions like that before buying into a potential investment, it helps me to sleep at night, knowing that it's not going to be a risky investment. If I know that the company is cash heavy, their dividend is growing, their economic moat is superior to everyone around them, and their profit margins are through the roof, that helps me to cope with the fact that I'm a short, ugly guy. Although I'm going to say this right now because I know someone is going to be a wise guy and comment. I'm going to beat him to the punch. All investments have an element of risk. There's no such thing as a risk-free investment in the stock market. However, not all are as risky as browsing on Amazon while drinking a beer or two. It might be fun in the moment, but in the morning, you're going to regret buying that 55-gallon drum of lube. All that to say, some stocks have less inherent risk than others because of their tangibles, their finances, their intrinsic valuation is undervalued, and their economic moats. Those are all things that you want to consider. Jokes aside, when we think about dividend compounders, there's not many of these companies around. I would argue there's maybe, on a good day, 100 to 150 of them in the stock market, depending on how strict your evaluation is. And I think that's a good thing, because it makes picking one from the bunch an easier decision. When there's thousands of stocks to choose from, a dividend compounder is a no-brainer to me, especially if it's on sale and undervalued. Speaking of which, you should go ahead and watch my video on SiriusXM, Nike, or even FMC. Those are the 3 companies that I just did an analysis on. And even if you disagree with my views, I guarantee you that they're going to be pound for pound the best stock analysis videos that are available on YouTube. I'm not joking. Lastly, when it comes to investing in the stock market, instead of just saying you invest in stocks, try thinking of yourself as an owner of a business. It sounds way cooler, and personally, I'm a bit of a loser in real life. So when I tell my friends and family that I'm a business owner, I definitely sound a lot more impressive than I actually am. But more importantly, psychologically, it'll help your decision-making process when you think of yourself as a part owner of a business rather than a stock trader. Because realistically, deep down in your heart, if you know that you would never want to be an owner of that business, then it would help you steer clear of investing into that stock. And at this point, the video is done, but I do want to go ahead and throw some amigo to amigo words, some friendly encouragement, and a reminder. If there is someone in your life that has done you wrong or hurt you, you gotta let it go. Forgive them, even if they don't deserve it. You should forgive them so that you can move on. Holding a grudge or staying angry at someone allows them to live rent-free in your head and in the worst way possible because you're always going to be bitter and frustrated whenever you think about them. The best revenge, on the other hand, is to not be like the person who hurt you or wronged you. I know, it sounds so stupid, you're probably like, shut up. But I'm encouraging you to take the moral high ground and to be the better person, because that's going to fill your heart with life instead of death. Taking an eye for an eye only repeats the toxic cycle. All that to say, revenge is not necessary, for their punishment is simply who they are. Oof, I know, that's a mic drop. That miserable, terrible, toxic person is who they wake up with and go to bed with. They're with that miserable person all day long. In my opinion, I think that's revenge enough. And besides, with maturity, it's realizing that hurt people hurt people. You're not going to see someone who's emotionally healthy with no trauma going out of their way to ruin someone else's life. It's usually someone that's carrying, generational trauma or had a lot of setbacks, and maybe they had a terrible childhood. I'm not saying that excuses their behavior, but they need healing as bad as you do. And with all of the BS that's happening around the world, we need more salt and light to help others. With that said, that's all I got, folks. And I wanted to remind you that we're getting closer and closer to that 5,000 subscriber goal that I've been talking about all year long. It's been taking forever, and we're getting subscribers every single day, and we're getting so freaking close that I am getting excited. Once we hit 5,000 subscribers, I'm going to be uploading my life and investing story video. Anyways, I love you guys. Stay safe, and I'll talk to you next time. Peace.